My name is Brian. I'm a certified financial planner, and I am the owner and I run Freedom Financial Planning, which I started this year, independent financial planning service. And so this webinar, this is the third or fourth one I've done already, and this is purely just educational. And then afterwards, I'll upload this as an unlisted video on YouTube for anyone who wants to look at it. I'll send you the link as well, and you will be able to have a look at it again if there are any details here that you want to go through. So this is purely educational. There's no advice. I can't tell you what you should or shouldn't do, but what we can do is learn a little bit more about this. And then hopefully after this, you know a lot more about trusts to be able to, make some good decisions on your own. So when it comes about trusts, there's a lot of information about trusts. It is in itself a postgraduate course, but today we're just going to focus really on surface level stuff. And then, as I said, as I go along, if there are any questions you have, please feel free to chip in. So the first thing is, what is a trust? People use the word like structures and judicial persons and all of that type of thing. So what is a trust? Very simple. A trust, and this is the technical kind of legalese definition. A trust is an arrangement for ownership of property of one person, which is by virtue of the trust instrument made over or bequeathed to another person or trustee or to beneficiaries of a trust. So if I can summarize that legalese, what it means is property is being placed from your estate into a trust, and it is either basically under the control of the trustees, that is what that point A means, for the benefit of the beneficiaries, or it is money or assets or whatever that is purely for the beneficiaries, but it is administered by the trustees. In essence, what this means is whatever you put into the trust is no longer yours. So some people say, I have a trust, and they'll use those words. That is not actually accurate. You don't have a trust. No one has a trust. Someone might be a beneficiary of a trust, but the trustees have to oversee that property like it's their own, and they have a fiduciary responsibility. And so whenever something goes into a trust, it has left your estate. It is no longer yours, and therefore it is now the property of the trust. The trust is not a person. For tax purposes and legal purposes, it is a legal person, but it is not a person. It is a contract. It's an agreement. And so that agreement owns whatever you put into a trust. It's no longer yours. And so all the different parties to a trust, there are three parties. Firstly, there's the founder. The founder is someone who sets up the trust. Sometimes a trust is set up upon death, and so it's the person who died who created it in their will. Most trusts, I think, are set up during life, and so it will be the person who kicks it off, sets up the arrangement, and puts stuff into the trust first, like properties or investments or whatever the case may be. You also get trustees. So these are the people that actually manage the trust. They oversee the trust. They make all the decisions about the trust. Everything that happens is their responsibility. If anything illegal happens within a trust, it is their fault, and they would be the ones that go to court and have to defend themselves. If anything happens that is prejudicial to the beneficiaries, in other words, it's not in their interest, the trustees have to carry the can for that as well. And so you often get family trusts. Most people talk about family trusts, and what a family trust is when you set something up for your family to benefit from into many years to go into the future. And so you might think of you own a farm or something like that, and you put it into a family trust so no one can take it away from you. The thing with a family trust is that you should have one independent trustee. And so an independent trustee is like a lawyer or an accountant. And the reason you would have that is to give your trust credibility, to show that it is not some sort of alter ego. It's not another version of myself that I can manage my own money. It is a separate legal trust, and I have an expert who's helping me run that trust. The other party is the beneficiaries. And so those are the people who benefit from the trust. They're the ones who get the income or the capital. They are the ones why the trust was set up. And so the trustees have a big obligation to the beneficiaries to take care of their assets. And very often the trustees are the beneficiaries as well. So if it's a family trust, there's a picture of 3 people. So the beneficiaries could be mom, dad, and child. The trustees could be mom and dad and an accountant or a lawyer. And maybe the founder was the mom. And so that is kind of a typical family trust setup. So you get 2 kinds of trusts. There's actually a lot more to this, but this is like a really big picture, zooming out type of thing. The 2 types of trust, the main types you can get is a testamentary trust. And you can see a picture of a coffin there. And that is because this is for something you provide in your will. You telling in your will, I want a trust set up and my assets, my estate must go into the trust upon death. And so that is a testamentary trust. It only exists once the donor, once the founder has passed away. That is very common if you have minor children and you want to leave things to them, or a child with maybe a dependent with special needs, like maybe the husband or wife has dementia and everything gets left to a trust so they can take care of that person with dementia. That is why you would create a testamentary trust. And then inter vivos, everything in law is Latin, and so inter vivos means in life, and that is something you create while you're still alive for strategic purposes, estate planning purposes, and so on. So the reason why I actually created this was because of a post I saw in the Fat Wallet community on Facebook, and Anonymous said, we would like to set up a family trust and put 3 properties into it. Good idea, bad idea. And that was kind of the post. No one really could give much context or input rather, because no one knows what the financial situation is, don't know what these properties are. But I thought to myself, this is very interesting. This is something, calculations we might do often as financial planners. And so as financial planners, we would help people decide whether it's a good idea or not to place something into a trust. And so what you have is the situation where this person said, I've got properties, I want to put it into a trust. It's such a common example of the type of questions people might be asking. And they hear about trusts. And so what they say is, I think it's a good idea. So hopefully the information I'll give you now will be helpful. For anyone who's just joined now a bit late, we just did a slight intro into trusts, just a few high-level kind of topics, and now we're going to go straight into the case study that prompted this webinar. So now I had to make up stuff because I have no information. So I had to just make stuff up. And so these are my assumptions and calculations for this Fat Wallet case study. So I'm going to assume that it is a mom and dad and child who are the beneficiaries of this trust. They want to set it up for their family, which is a very common scenario. And so what you can see here is a few properties that this person might be trying to get in. She said, or he or she said that they want to put 3 properties into the trust. So let's look at this example as a primary residence. Maybe these people have been living there for many years and it's now worth 4 million rand. It says proceeds, that is the market value. So if they sell the property today, what will they get? 4 million rand. Let's just say they bought it for 1.8 million rand. So the base cost is 1.8 million rand. I'll tell you why these calculations or these values are important now. Let's just say they've got 2 extra properties that they have for investing. And the one is a property in Cape Town, and it is worth 3 million rand today. And when they got it, it was worth 2 million rand. So you can see there's like a bit of a gain there as well of 1 million rand capital gains. And this property generates income of 80,000 rand a year. The second investment property is a Johannesburg property. I'm just taking a dig at anyone in Gauteng because I'm in Cape Town, but you can see I kept the value, the market value, and the base cost the same. Maybe they bought this recently, but my clients who have property portfolios in Gauteng, it is a bit slow, so the growth hasn't been much. And let's just say this property brings in 50,000 a year. Now, the challenge is that these properties have to be placed into the trust. Okay, so when you place something into a trust, like a property or anything, for example, you are disposing of it. It's changing ownership. And so when you dispose of something, it triggers capital gains tax big time. And then obviously the fees of transferring properties, you got transfer duty, you will have conveyancing costs, all these different things. And so it's quite important to remember that these costs have to be factored in because they have to be paid at that moment. So that is why I have market value and base costs here for these properties. So if I do my calculations, now I've done all the calculations in the background, and I have no idea why this has shifted now to the right, but you will see it says the capital gains tax payable from moving these three properties into the trust from your personal name is about 208,000 Rand. Doesn't sound too bad, but that will be added. That's taxable at your tax rate. So, SARS will want that. So that money must be available in cash to pay to SARS upon the assessment at the end of the year. The transfer costs, though, will be about 530,000 Rand for all of three properties. So that would be the transfer duty and the conveyancing costs and any other sort of litigation or administrative costs that might come with it. The transfer duty are calculated, but the total costs I got from uber.co.za, all of the, as you might know, all of the kind of property housing financing websites have calculators. So I just did some rough calculations there for a total value of 8.5 million Rands properties. Now, the transfer cost has to be paid up front. So you now need 700,000 Rand to get three properties into a trust. So you can start to see that you need a very good reason why you want this money, these assets in a trust. There must be some sort of legacy reason or whatever the case might be. And we will get to that a bit later on in the slides. But it's important to understand why you want to place these things in a trust, because you've got to have already 740,000 Rand available. Now, what you've got is a loan account of 8.5 million Rand. Okay, let me explain this to you. There's two ways to get things into a trust. You can either give it to the trust. And if you give it to the trust, you will pay donations tax. So donations tax on 8.5 million Rand will be 20%. So 10% would be 850. So it's like 1.7 million Rand cash you would need to pay in donations tax to put the stuff in the trust. If you don't have that money available, and no one really does, what you would then do is say, I gave this, or I sold it to the trust, all of these properties at market value, and they have to be market value. It is audited. And now what's going to happen is the trust has to pay me back. Now it doesn't have money because it just has three properties. So there's a loan account. Now the loan account is 8.5 million Rand, fair enough, because that's the value of all the properties. But now a loan means there must be interest. And legally, and remember, a trust is a taxpayer and it gets audited. So legally, the interest must be paid to you. So the interest rate, and this is the scary part, the interest rate is called the official rate of interest that is required on loan accounts. This is for a business, this is for a trust. Wherever there's a loan account, you actually have to apply the official rate of interest. It's a tax term. And the official rate of interest is the repo rate, which is currently 8.25. It's very high, plus 1%. So it's 9.25%. During COVID, it was like 4.5. Now it's 9.25. So the interest that the loan has to pay you is 786,000 Rand a year on 8.5 million. Now the loan has to pay you that. If it doesn't, the loan account increases and it's in arrears, it's like bad debt. And so you've got to apply all the principles to that as well. So what you would do in this instance for 8.5 million is you would say, well, fine, the trust owes me 786. I'm going to donate 100,000 to it. I'm going to offset it with my 100,000 donations allowance. And that brings it down to 686,000. Then I will allow the trust to pay me back that money. If it's got income or something, it can offset my loan account, which it won't have enough of. But then what you can say is, I bequeath the rest. I donate the rest to the trust. I'm basically writing off the debt of 686,000. Then you would have to pay donations tax of about 130 odd thousand rand, 20% thereof. And that might be a more feasible way to do this. In a low interest environment, it might be a different conversation. And so you would have your accountants, your financial planners. We would all do the calculations for you to try and work out the best way to tackle this. So you can see there are things to consider when putting stuff into a trust. Back in the day, people just threw everything into a trust and didn't care. But that's no longer the case. There are so many laws around it. And there are many more things that I won't even get into in this webinar, which further impact on this loan account. But it's kind of post-grad level, and I don't think we're trying to teach financial planners here, but this is just to give you an idea of the complexities around it. Now, this is an extreme example, and for a client like this, I would advise, if they need to move everything into a trust, I would advise to phase it in over years. So you do the one property first, and then the next property, and then the next property. So and the primary residence, one might always be reluctant to put it into a trust because a primary residence has a 2 million rand capital gains exclusion on it. So, you would lose that in a trust because the trust doesn't have that. So what are the pros of having a trust? Everyone talks about trusts around the braai and they say, yeah, I've got to have a trust. I must put my stuff in a trust. What are the pros of having a trust? Well, there's no estate duty. That's quite obvious if you think about it, because estate duty is payable if you die. Trusts don't die. They're not a person. And so there won't be estate duty on anything within the trust once it's in the trust. Now, everybody will pay no estate duty on their estate for the first 3.5 million rand. That's what's called the abatement, estate duty abatement. And say the most typical scenario is husband and wife. I die, she gets everything. She dies, I get everything. When you bequeath everything, when you leave everything to your spouse upon death, they also inherit your 3.5 million rand abatement. So now your estate is 7 million rand. There's a 7 million rand abatement on your estate. Sorry. So now you think to yourself, well, how much is my estate worth? Well, my estate is worth 40, 50 million rand. Yeah, I should think about a trust, potentially. But if my estate is worth, say, 8 million rand, that includes my retirement fund and my house, well, then it's not really worth it because the retirement fund is not part of the estate. And so what you might realize is it's not worth the effort. And that's why for most people in South Africa, a trust is no longer worth it. However, one of the big pros is if you do have a sizable estate, there's no estate duty. And remember, estate duty is payable in cash. SARS only takes one payment form. Another thing that's quite obvious, there's no capital gains tax within a trust if you don't dispose of that asset. Now, that's obvious for anyone. I mean, if I don't dispose of my house, I'm never going to pay CGT. But upon death, everything is disposed of. Even if you don't sell it, it is disposed of upon death, and tax is payable. Now, once again, if you bequeath everything to your spouse, then there's no capital gains tax payable because they inherit your estate the way it is. But to anyone else, to a child, anyone else, there will be capital gain tax payable. And yeah, so that's a bit of a problem. And I think that that is why it's so popular to have the trust for some people when they have massive estates and there's a lot going on. 20% of that estate value over 3.5 million rand is payable to SARS. That's estate duty, and CGT is applied at your tax rate. It becomes quite a big tax bill for the high net worth people. Another good reason to have a trust, the pros of it rather, is to make sure that there's smooth succession upon death. What that means is all of the people in the trust, the beneficiaries, if you pass away and you're one of the beneficiaries and trustees, it's business as usual, really. They might have to replace you as a trustee if you were one, but otherwise everyone still has their assets. Nothing was sold. There's no taxes payable because you passed away from the trust. It just carries on as usual. It's a very smooth sailing process. No one has to worry about executors and the executors' fees as well, which can be quite high, especially if you have a large estate. Another thing to consider, it's not suitable for everyone, but income from the assets can be distributed to more than one taxpayer. So if you have, for instance, three beneficiaries, and in this example, there was mother, father, and child, the income from those rentals, I think it would have come to 130,000 in total per year. Instead of going to mom and dad, who maybe their tax rate is 35 or 40%, they can actually distribute some of that to their child. But if you do it on paper, you have to at some point actually pay the money to them. And that might be fine because you might be building up an education fund for the child, and you build it up within the trust maybe, and then at one day, 18 years later, you decide to release it so it can pay for the first year of varsity. That's fine. And then you've taken advantage of that child's, firstly, their income threshold. They don't get taxed on anything up to, like, saying 97,000 Rand at the moment. Then only afterwards it's 18%. Whereas maybe mother and father are both earning $1 million a year, they're paying already 30-odd% income tax. So it's clear that to distribute the income to the beneficiaries, especially younger ones, can sometimes be worthwhile, but it's very much a case-by-case basis. Okay, cool. Something else to discuss here, which is very important, because you might hear some people talk about freezing or pegging your estate with a trust. I'm going to scroll back to the example just now and talk you through it. But first, I want to read this little blurb I wrote here. And it says, estate freezing is when you sell your growth assets to your trust. Your loan account remains static. That 8.5 million we saw in the example just now, it remains 8.5 million. And over time, it might reduce. It will reduce over time potentially as you get people coming on board and they're paying, you're getting more investments coming on board and they're paying down your loan account. So it could potentially be a case of your loan account is frozen or it reduces in size. But the assets, the houses in the trust, or your unit trusts or share portfolios, they're growing and they're no longer in your estate. So if I go back to the example, I have to scroll like this. So if I go back to this example we used in this case study, these properties were put into the trust, sold to the trust, and the loan account was 8.5 million. Now, say in 20 years' time, this person passes away and their loan account is still 8.5 million. Estate duty is payable on 5 million. That's the 3.5 million abatement that I mentioned earlier on. That is deducted, and then they pay 20% on the 5 million. But say these properties, which now are worth 8.5 million, in 20 years' time, they're probably going to be worth like 28 million. And so that growth of 20 million did not happen in your name. It happened in the trust's name. And because you died, it doesn't impact the properties. They carry on existing. Your children are using them, renting them out, living in them. That's the benefit. And so what people do when they realize that they're amassing quite a large estate, they're doing well, business is pumping, and they're realizing that things are just getting bigger and bigger, then they start setting up trusts. They'd rather have a loan account that is static and freeze their estate, freeze the size of their estate where possible, and let all of the growth happen outside of their estate. So that when you die, you don't donate 20% of everything to SARS. And so that is what estate freezing means. The other word for it is estate pegging. Like you're pegging it right here and you're not letting it get any bigger. Another pro rather for having a trust, and this is applies to testamentary trusts as well, because anyone with minor children should have a testamentary trust built into their will. And the pro is that it can receive lump sums for minors upon death. So if you think of your retirement funds, and if you think of the life cover, retirement funds and life cover, what's going to happen is that pays out. But if there's no trust set up, and now this will scare you, so, take this from where it comes, but if there's no trust set up for them and there's no other parent, so say you're a single mom or single dad, the last surviving spouse, and you've still got minor children and you pass away, all your life cover and that you've left for little Johnny won't go to little Johnny. It will go to the beneficiaries or the guardian's funds, depending on if it's a retirement fund or life cover. or potentially the control of a guardian. But I mean, not, the government, the master of the High Court will suss it out as far as I'm aware. And you never know what the family might do with all those millions of rands. And so what happens is government institutions, the beneficiary fund or the guardian's fund, will watch that money for your child until your child reaches 18. And when I say watch that money, what they do is they effectively put it into money market. And then if the guardian, say an uncle or aunt, is looking after the child and they want to have 5,000 rand to send the child on a school trip, they have to stand in a queue, get the right paperwork, ask for it. Like several weeks later, maybe some money will be paid out. It's a loss. And so all of my clients who have minor children, they've all got a testamentary trust clause built into their will. I think a professional trustee and an advisor can do a lot better with that money than the government can. And so it's essential. That's one of the pros of having a trust. It's essential to be able to have that available. Okay, so what are the cons of trusts? This is a very short list. There should be many more, but I can't spend all day long bashing trusts. But the first thing is it's difficult to say. It's difficult to run, firstly financially as well. So a lot of people put assets into a trust like a property or something. There's no cash in the trust. So they're going to pump more money into the trust every year to pay bills. You're looking at least 15,000 a year if the trust has nothing in it, like 0 cents. You just have a trust, like you have a shelf company, just to pay the annual financial statements, the tax submissions, to pay for the time of the trustee, which will be either probably a lawyer or a qualified accountant, like a professional accountant or chartered accountant or something like that. At least 15,000 a year, probably more. And so that's the first con, is that it does cost money to have. A second thing, which is something difficult for some people to wrap their minds around when they set up a trust, is whatever is now in the trust is no longer yours. The trustees control it for the sake of the beneficiaries. You cannot control it like an alter ego. It's not actually a bank account at arm's reach. It is no longer yours. And so if you think about it, if you have a house, you put your house in the trust. I've had many queries about people wanting to put their primary residence in a trust, for instance, because they want to keep it for their children and grandchildren. It's a big, lovely home. And maybe they don't trust their children with money or something. Now you want to repaint the house, or you want to buy a new geyser. You've got to assemble the trustees. You've got to have a meeting. You've got to have a resolution. It's got to be documented. It must be signed off. There's got to be, you will have your constitution, but there's got to be a vote, majority vote. And control is a bit of an issue. And so you are no longer in control of what's in there. You're one of at least 3 people who will decide the fate of what is in there. Trusteeship, I alluded to this earlier on, but it's quite an onerous task. So you have to actually be switched on to be a trustee. You've got to pay attention. You've got to make very good decisions. A lot of people try and use trust to evade tax and to potentially schmuckle and do a few things under the table. If it comes to light that happened within a trust or was entertained, the trustees are the ones who will stand in front of a judge and potentially go to jail or pay massive fines, not the beneficiaries. And the beneficiaries could be the trustees, but sometimes they're not. I mean, you can think of it now. If there's a big family of 6 or 7, maybe you own wine farms or something, and you've got 3 or 4 trustees making decisions. If you're the beneficiary, you didn't make the decision, but the trustees made some bad decisions. And if they lost money in weird schemes or syndication schemes or something, they would have to account for it. They could be in a lot of trouble. And so trusteeship is not a joke. And that's why it's always advisable to have at least one professional on the board of trustees to keep everyone in line with regulations. As I mentioned earlier on with that case study, and anyone who joined later on the recording, you'll be able to go through it as well. It showed how difficult it is to actually get assets into a trust without bankrupting yourself. So there's donations, tax considerations, there's interest on loan accounts, there's all sorts of, and there's a lot more we just cannot go into now. But there are a lot of things to consider. So getting assets into a trust can be tough, and that is one of the reasons why a lot of people decide not to pursue it anymore. Income tax within a trust is flat 45%. So any income earned is a flat 45%. There's no sort of exemptions for interest earned or whatever. But that is if the income is retained in the trust. Generally speaking, what you want to do is distribute the income to the beneficiaries. In our example, we had a mom and dad and child, and you want to pay that to them, and then it is taxed in their own hands, with their SARS assessment. But if income is retained in the trust, 45%, even if it's R1. So it's quite tough as well. And capital gains tax is 36%. So it's double the worst case for a normal person. You can distribute capital gains as well to beneficiaries. So if you sell something and there's a decent amount of capital gains, you can distribute them like a third, or whatever the case may be. But yeah, within the trust, if you retain it within the trust, it is very punitive. You can see they're trying to make it less attractive for everybody. Another one of the cons is the fact that SARS is obsessed with trusts right now. And they eat, breathe, sleep trusts. All they're thinking of is how to get a better look at all the different trusts and control it, because people have in the past obviously tried to evade tax or avoid tax using trusts. A lot of wealthy people have a lot of money in there, and they didn't always get it in the most legal ways. So they didn't declare things the way they're supposed to. And so SARS has its eyes on them. And what it means is almost every year they're making a change to the law, which is kind of not surprising. We know they're changing laws, but it might undo all of your plans. And so you might have this awesome, great scheme, and then you set it up, and then 1 year in, it's no longer worth it. And that is why you hear sometimes these days of people dissolving their trusts. They're just getting rid of it, which also is difficult, because once you get rid of the things in the trust, it triggers the capital gains tax and all of that as well. So it's a tricky thing to get into if you're not sure if you need it. That is why to get an assessment from an accounting firm or a lawyer or something like that to help you determine if it's worthwhile. A lot of people talk about setting up trusts, and then I ask them why. And then they tell me, I want to make sure my children get the money when I die, or I want to make sure this happens or that happens. And a lot of these problems or challenges are actually solvable using other options that are out there, which are not as punitive as trusts. Firstly, retirement funds and living annuities are not part of your estate. There's no state duty payable on them should you pass away. What there is, though, is there are some T's and C's about, like, if you're just about to die and you put all of your cash into a retirement fund or a living annuity, and then that person then, like your beneficiary, withdraws it as a lump sum, there are calculations to work out what the estate duty would be on that, because you can't just, because if you over contribute to your retirement fund, there's a rollover. If it's above 27.5%, there's a rollover even in death. But if you do it under those circumstances and it goes into a living annuity, there are certain T's and C's that have to be met. And if they're not, you will pay a lot of estate duty on that. So it's not as easy as just like trying to, on your deathbed, do this and that to try and get out of tax. But in general, living annuities and retirement funds are available. They're not part of your estate. It's a way of getting the money out of your estate without paying taxes. Furthermore, if you have a ton of money, say a ton of cash or capital, and you realize you're not going to use it all and you want it to go to people, you can, for instance, take that, put it into a retirement annuity. Some companies have what they call an RA for a day. You just need it to go into retirement annuity quickly. Then immediately you put it into a living annuity. So you retire that retirement annuity. All the cash goes straight into the living annuity. There's been no tax so far. You've got a tax deduction now upon death. And say you put in 5 million Rand, it goes from the RA to the living annuity. Then you die, and the beneficiaries, say it's your children or grandchildren, they withdraw an income, no capital, an income for maybe life. Maybe it'll be for many years until it runs out. then there's no estate duty. Then you've successfully got around that. But if people want the capital, the amount of money they withdraw from it as capital, that realistically speaking, most of it or all of it will be dutiable in the deceased estate. So there are T's and C's, like I said, and that's why it's good to do research on it, speak to the right people, pay a fee for a consultation, and they can help you work out how to make sure the right people get your money upon death in the most tax efficient way. Okay, so the other options are you don't need to necessarily set up a trust while you're alive. You can set one up upon death. And like I mentioned earlier on, that is why we provide for testamentary trusts in wills. So it's 100% essential if you have minor children. Don't care if granny is going to look after them or auntie or uncle. Set up a testamentary trust. Auntie and uncle can be the trustees, but some of the retirement funds and the life companies might not want to pay out, and they have no real obligation to pay out to someone else. They want to pay out to a parent, like a legal guardian, or they will pay to those government, as parastatals I mentioned earlier on, the guardians fund and the beneficiaries fund, and they will run that fund for your child, which I think is not necessarily the most attractive prospect. Another way of getting money to people, a lot of people say, I want to make sure that the right people get it, the money, and it's not wrapped up in a deceased estate. It doesn't take 18 months to pay out. Well, I've done a webinar already on life-wrapped investments. If anyone wants the link, they can let me know. And so in a life-wrapped investment, like an endowment or a sinking fund, you just put someone's name on the bottom and they will be the beneficiary and it will go to them should you pass away. No getting frozen in the estate, no executors fees on it either. But it's still in your estate. It's still dutiable, but it goes quickly, just like a life policy. It'll pay out pretty quickly. But yeah, it's quite effective and it solves a lot of the people's problems when it comes to estate liquidity. Cool. Shireen, you can shoot. Oh, okay. Sorry. I see your question here in the chat box.
Sorry. No, yeah, sorry. It wasn't actually that question. I was trying to see how I unmute myself. That one day, yeah. So, you were talking about the 1 day retirement annuity, you just put it in, then
Yes.
you put it into the living annuity. If the person then gets the drawdown, is it also every year they choose between 2.5% and 17.5%? That goes to the beneficiary.
So they would, like a pensioner, yeah, they would get that. And I've got clients where that's happening right now. So I've got a client, she was widowed during COVID and 39 years old, and her husband was an executive somewhere, and she has 3 children. And so what happened was they spoke to, at the time, accountants and all that type of thing, and they structured it for tax purposes that not all of the pension funds pay out. They got some of it paid out, but there was a lot of life policies. I think he had something like 8 or 9 times annual salary as benefits. So they got like a lot of money paid out there, and then the rest got paid into living annuities. And so 3 children and the mother each have living annuities until whenever, and of varying amounts. And so it's a nice thing to give someone income for a very long time, but they can, and then it's taxed in their hands as income tax.
Okay, so say if you put the whole amount into the retirement annuity, say you had $1 million and you put it in the retirement annuity, now there's also that deduction. Does that also go in the estate, that deduction? Well,
so if they,
I suppose you've got no income. If you've got no income, then okay. So if you've got no income and then it gets carried forward, are they able then to take out of that retirement annuity the lump sum, like tax-free, basically?
So yeah, this is why they put the law in, because people did that before
Yeah.
a lot on their deathbed, setting up RAs. So what happened was they said, okay, fine, you can do this. You can put that 1 million rand into the RA, and say you don't have really income at the moment, you're a pensioner or something, and so your 27.5% maximum contribution is basically like 27 rand or something. So what they'll say is the full R1 million could be rolled over. Now you pass away. Now your beneficiary says, I want the full million paid out of the RA. They will say, okay, so they're withdrawing a lump sum of R1 million. you use that just before death to mitigate estate duty, that million will count in your estate as an asset.
Okay.
So it doesn't mitigate estate duty. However,
how do they know that you did it just before your death to do, you know, how do they see your intention?
No. It's not about intention. It's not about intention. It's about what happened. So what happened is, so put it this way: if your beneficiary, and this is a good question, and it's actually something I would do if I talk about retirement funds in the future, because I'd actually need a lot of numbers in front of me. But what I'll explain is this. Let us say, for instance, your 27.5% maximum deduction for the year is 100,000 Rand. Okay. Now, the 900,000 is clearly going to roll over. Now you pass away. By surprise, you were knocked over by a bus. Now you got 900,000 Rand, and your beneficiary of the retirement fund says, I want to take that full million in cash. What's going to happen is the 900,000 Rand non-deductible contribution to that RA, because the person took it as a lump sum, it will be regarded as deemed property in your estate. And that will be estate dutiable. Okay.
Okay. But are they allowed to take the whole lump sum? Are they not allowed to, can't they only take a third?
No, upon death, it can be paid out however anyone sees fit.
Okay.
Yeah, so upon death, it can pay out, but then say the beneficiary sees this and says, no, I don't want it. Rather put that million into an annuity for me, a living annuity, or give me, because what they'll do with an advisor or a planner is we'll do like, get the sweet spot in terms of tax, like what's the sweet spot, the maximum withdrawal before starting to donate too much to SARS. And then we would say, take the rest maybe as an annuity or something. And so what they would then do is have a living annuity, and then you've got an income, and then you've mitigated tax accordingly. But if you take the full lump sum, the over contribution, the 900,000, any part of that was used to pay out a lump sum to the beneficiary will be regarded as property for estate duty purposes.
Okay. And then you pay 20% on that.
Yeah, well, it'll go into the calculation, and then you've still got your abatement and all of that.
Okay. Sorry, just my other question that I had said, what with originally where you said you had the 8.5 million Rand loan to the trust.
Yeah.
What happens to that loan in your own estate when you die? Is that seen as an asset?
Yeah, a loan account is always an asset, and that is an asset in your estate should you pass away. So that will be dutiable. So it will be part of the estate duty calculation. So this example, it's estate freezing. As I mentioned earlier on, and as Shireen talked about, to get the loan account was worth 8.5 million in that example. Properties can grow forever and ever and ever, but in your estate stays at 8.5. So you froze that amount in your estate. So this example of estate freezing, this is the scenario, and it's a client of mine. He's moving his estate into a family trust. He is on an aggressive estate freezing exercise with his accountants. He was also in the process now of buying a new primary residence. He's not sure if he should buy the primary residence in a trust or in his personal name. Remember, the primary residence capital gains exclusion of 2 million Rand is not available in a trust, so you lose that. He took that information, he called up his accountant, who's a CA, and the accountant said, don't put in the trust. And he said, okay, cool. So then he sent me a mail and he asked me the same scenario. As a financial planner, I have eyes on everything in his life. And so I was able to come up with some calculations for him. Just a bit of background, he's a high net worth individual and he owns properties as a bit of a venture. When we do calculations, we have to come up with some assumptions. Some things we know and some things we don't. What we did know was he looked at a house for about 6 million Rand. It was going to be 100% bonded. So there wouldn't be a loan account. He wouldn't be putting money into the trust to put down a deposit on the house. That was the scenario. I said to him, look here, if you were to dispose of your house, when would you do it? He said never. He's never disposed of a house. He's only bought more. But we have to come with a point where something happens. Either you die or you sell the house to work out in terms of capital gains tax and estate duty, if it's worth having it in your personal name or the estate. So we came up with 15 years. And we did 2 scenarios. He dies in 15 years, or he sells in 15 years in his personal name, and also in the trust. We said the growth rate of the property was 5% per annum, and it would be, upon death in his personal name, the property would be bequeathed to his family trust. So this is cool to see, if it's in the trust or out the trust, what's the difference? So what we came up with was, if it was in his personal estate, in 15 years' time, if he sold that property, the CGT bill alone would be 800,000 Rand, even with the 2 million exemption. We don't know if that 2 million exclusion, rather, is going to be increased. So we have to kind of play it as it lies. If he died in 15 years' time, the CGT would only be slightly less. It would be 750,000. Now, as you know, every year you get 40,000 Rand CGT exclusion, and upon death, it's a 300,000 Rand in that year. For that value of property, the only difference that made was 50,000 Rand. The estate duty on the property alone in 15 years' time, if he died, was 2.5 million Rand. Okay. So we assumed his 3.5 million Rand estate duty abatement was fully used up by everything else in his estate. So in taxes upon death, just on his house where he lives, the taxes would have been 3.25 million Rand. The executors' fees on that would have been, at the highest rate, it would have been 500,000 Rand. So you're looking at 3.75 million Rand in fees just for having that house. Now, obviously, in 15 years' time, money will be very different. A million Rand now is definitely not going to be a million Rand in 15 years' time, but this just gives you an idea of the bills that are payable upon their property. In the trust, if the trust bought the house now, and if it sold it in 15 years' time, the CGT would have been 1.16 million. So you can see it's much higher than in your personal capacity. There's no exemption, 2 million exclusion. There's no 300,000 Rand or 40,000 Rand for the year CGT exclusion either. But that's all that's payable. There's no estate duty and no executive fees. For him, it was a no-brainer. And there's only one reason why it was a no-brainer. He does not sell properties, even former primary residences. So he's an accumulator. And if you don't plan to sell something ever, yeah, maybe a trust is a good idea, especially if it's something that grows in value quite aggressively. If you have any topic suggestions, please send me a mail or something like that, and you can suggest something and I can flesh it out for you.